So we already looked at the baseline metrics, which helps us to apply our approach to the big samples of the company and to find the types of qualitative growth among the competitors across different industries, and gives us some lessons from the previous research. To continue, we need to move forward, and the step 2 is adding additional matrices which are also very useful for the growth analysis on the basis of finance-based approach. From the first glance, if you look at that slide, it seems that it's just the same metrics, but be attentive. On the horizontal axis, we now have the economic spread, but not the growth rate for the market value of company's capital. Economic spread, and in the middle point of it, of course, it's better if we will get here the spread equal to 0. Then to the right side of that matrix, we will get the companies which are generating positive economic spreads or positive economic profits. Positive economic profits means, I would like to remind you, that the company's actual rate of return on the capital employed is well above than its required overall cost of capital or weighted average cost of capital. Then on the left side of that matrix, on the contrary, we will get the companies with the negative economic spreads and negative economic profits, which will mean the actually earned rate of return on the capital employed is much lower than the required for the risk compensation rate of return on the overall capital or weighted average cost of capital. Other things are still equal, are very close and really similar to the baseline metrics. In a few minutes, I will be back to that particular type of the metrics. But what I now would like to strengthen when talking about this additional metrics, I would like just to mention that again, we may have the same types of quality of growth: balanced, focused, aggressive, and lagging. But as compared to the previous metrics, we are now talking in terms of the fundamental value drivers which are captured by the economic spread, but not in terms of the market value growth or market value rate of growth, which captures not only fundamental processes in the value creation within the companies, but also is under huge pressure of expectations from the investors. We should keep it in mind. Let's move forward. So now I would like just to present you the metrics which have been developed by the McKinsey. And McKinsey global consultancy company is really well known in the world. They, of course, also are focused on some problems of growth analysis. And they submitted for us and they provided for all the users 2 additional types of matrices, which I also find to be really very productive and useful for the business analytics based on the value creation idea. What do we see here? On our vertical axis, we are looking at the value component, which is provided by the future growth opportunities of any company. Remember, in our previous course, which is corporate finance course, we already discussed that we can look at the value of the business not only through the lens of discounted cash flows, but we can also say that the value of the company could be divided into 2 very interesting components. One of the components, the first one, is so-called current operating value or the value which is generated by the free cash flows at the risk level the company has now, bearing in mind that the company doesn't have, as if it doesn't have any growth opportunities. It's based on the current structure of the assets, current types of the assets that the company already has. And those assets are the results of the previous past investment project. That's why it's called current operating value. So we've got already a set of assets with some technological quality, with some productivity, and they are generating some free cash flows for the company, and the company is operating under some predetermined risk level. So the current operating value, this is the first component in the value analysis, but the value of the future growth opportunities is something really very different. In a few minutes, I will show you how we can compute these different metrics that are used to build and to develop that metrics for growth analysis. But as always, we need to find the median value. So that's why first we need to normalize current operating value as well as value of future growth opportunities, dividing them both by book value of companies' assets. Doing so, then we can find the mean values for the current operating value per $1 of book value of the assets, as well as the mean value for the future of growth opportunities per $1 of company book value of the assets. And still we have these four quadrants in the matrix. And the quadrant 1, Q1, says we've got here the most qualitative type of growth. But now we're looking at the quality of growth from a different point of view. We're not comparing sales growth rates across the companies. We are not comparing the market value of the capital growth rates across the companies in this sample. What we are comparing, these are the components of their value. So those who are called excellent companies in the Q1, what do we know now about those types of companies? They are capable to extract higher discounted cash flows from each dollar from already existing assets. And that's why their metric based on the current operating value per each dollar of book value of their assets is much higher than the mean value for the overall sample. So those companies have their excellent skills in selecting the investment projects in the past, in running all these current investment projects and extracting, generating the cash flows and keeping their risk levels. On the same side, they also are excellent in terms of the capturing value of growth opportunities, and value of growth opportunities per each dollar of their book values of total assets is also higher than the mean across the companies in this sample. How about the Q2? McKinsey consultants call them traditionalists. Those companies are skilled and professional in their management teams are really have some high quality in selecting projects in the past. So they have this very nice records for their past decisions. And they got those projects already implemented, and they have those high skills and professional qualities in extracting free cash flows per each dollar of their book value of assets and keeping the risk levels untouched. But they do not have enough proficiency. They do not have enough professional skills in terms of capturing new growth opportunities which could be opened in the market. They don't have that particular feeling for capturing these opportunities. They don't have enough skills, and maybe they don't have also enough assets among those they already implemented in the company. So they are mostly qualified to do very traditional, very standardized decisions and to run the company in a traditional way. Those who are in Q3, according to this classification, those are high generators of expectations for the investors. So they are behaving themselves on the basis of some very good proficiency, very good intellectual qualities of the management team. So doing so, they make a very high impression on the outside investor, on the capital market. And they are also, they've got some records in the past, how they were capturing the growth opportunities in the past, so on and so forth. But in terms of the current operating value, they are not as high as in terms of the value of the future growth opportunities. So they're mostly focused on looking out of the company, on searching for new growth opportunities, new projects, new ideas, new customer preferences, new dynamics in new markets. And they are really qualified and really very agile to be adjusted to these new growth opportunities everywhere. And Q4, as always in the metrics, they are lagging behind all these types of companies, and they are just generating assets. They are introducing new projects, they are installing new assets, but the productivity in terms of the cash flow generating capacity and the risk level of their operations is not as good as other companies across this sample have. So that's why they are called here by McKinsey consultants assets generator. So what we can summarize from that interesting matrix? It says us about the financial visibility of the growth of the company, or if you want, financial performance of the growth strategies and investing strategies, which of course are behind any growth strategies of a sample of companies. They are providing for us a very new benchmark criteria, because now we can just classify companies around us in our industry or across different industries in terms of the current operating value capacity and the capacity to capture the future of value growth opportunities. I remind you that I will show you how to compute these metrics, to build the metrics, just in a few minutes. The second type of metrics, again, introduced by McKinsey. Now, if we just look only from the point of view of the criteria, the future growth opportunities value contribution, then we have to differentiate between the short-term expectations of investors and long-term expectations, because value of the growth opportunity is totally based on the investor perceptions of all the history of company, of all the fresh actual events happening in the company, of all the news the company is introducing to the capital market. It's based on the investor perception of the capabilities of the management team to capture the new opportunities, new information, and to be the first or among the first in running these opportunities and implementing them into their strategies. So the expectations could be mostly focused on the long-term results, and investors could believe that the company will be performing well really for the long-term period in time, or vice versa. Investors may understand it or perceive it in a way that the company could be really good only in a short-term period, and this really better performance will not last for the long-term period. That's why that matrix represents additional approach for benchmarking across the firms that we need to understand before setting our own plans, how we're going to create the value of the company. Who is now in Q1? Those who are really champions in this interesting competition for the expectations of the investors. They can balance between the long-term expectations and short-term expectations due to the professional skills of their management team and due to the concrete events that are now familiar for the market. Those who are in the Q2, they are really skilled in long-term expectations because they always are investing for the long-term period. They are selecting the projects where we have long-term period payoffs. So they are very solid, very sound in their investing policies, and they proved for the last periods of time that they are running well those projects with this solid long-term payoffs. Those who are in Q3, they look like a sprinter in the sports competition. Those are the runners for very short distances, but they are very, very good runners within this short period of time. And finally, the Q4, those are still and again outsiders. The long-term expectations for Q3 and Q4 are really low in terms of the investor perceptions. And for sprinter type of growth, the short-term expectations are really high. But for outsiders, the short-term expectations are also low as the long-term expectations from the investors are for the outsiders sitting in the Q4. So how we are going to compute all these variables just to build that matrix and to provide this benchmarking for us? How we are going first to compute the current operating value, COV. We need to apply the assumption of no growth. So as I already mentioned, current operating value means you have some particular asset structure, particular level, technological level and productivity level of your assets, which are already providing you free cash flow. If we apply the free cash flow to the firm, then we, with the assumption of no growth, should capitalize the free cash flow to the firm by the overall cost of capital, which is, of course, weighted average cost of capital. So FCFF divided by WACC will give us the value that is generated by these free cash flows when the company is not pursuing the growth and the growth rate is really zero. Then we can use the enterprise value, which is abbreviated by EV. So EV, to measure the enterprise value, of course, we need to describe the market value of the total overall capital of the company. But in many cases, the company's debt will not be presented by the corporate bonds issues traded in the open market. So in that case, many analysts will recommend to compute EV somehow in a mixed manner. What do I mean? When you are describing the equity capital, you will use, of course, market price per share, P, and multiply this market price per share by number of shares already issued. They are called shares outstanding. So your second term on the right hand side of that equation really describes market value given by the prices investors are paying. They are willing to pay these prices per each part of the equity capital. But your debt capital is described in terms of the book value data, which is not, of course, the market value of the debt capital. That has nothing to do with the market value of the debt capital. So we need to use long-term liabilities from the balance sheet and then subtract the cash from the balance sheet. So two book value based parameters will describe the amount of the value of the debt capital. Of course, it's not the market value. It does not pretend to be the market value of the company debt, but it at least pretends to be to provide the comparability for the overall enterprise value. Analytics, when you need to get a big sample of companies in very different environment, you will be really sure that a great proportion of those companies in the sample will not get their debt organized in terms of the corporate bonds traded, corporate bonds still outstanding. So the second step on that slide means finally we will arrive at an enterprise value, at a V. And then if we compare now the overall value, which is enterprise value here, with the current operating value previously computed in the first step, we will get the residual amount, which captures the value of future growth opportunities. To go further to the next matrix, which was capturing the horizon of the investor expectations, whether it's short-term or long-term expectations mostly, we can follow the logic which was behind that McKinsey consultancy metrics. So for the short-term horizon, we may apply the standard technique for discounted cash flow valuation, but we'll keep the forecasted period just for the period only for 2 to 3 years. And computing this free cash flows, their present values at the rate of weighted average cost of capital, and then summing these present values up, we will get the total sum of free cash flows for 2 or maximum 3 years. So we'll get the value for the short-term component in the future value of growth opportunities. And the residual part would be the long-term component. So from the future value of future growth opportunities, we will subtract already computed by the discounted cash flow standard valuation for 2 or maximum 3 years, some component which is capturing the short-term expectations, and the residual will give us the data or the value for the long-term component of the value of future growth opportunities. And then the matrix can survive. And then we can, after all these computations, just collect the data and put these companies into the matrix, and collecting these mean values for all the components already computed. Then we will get a picture. It will be a nice, very smart and very reasonable picture of the benchmarks for the company growth. So intermediate conclusion from that second step of growth metrics applications. Our finance-based approach that we are promoting that course and in that master degree program as well provide wider vision and deeper vision on the best practices of growth strategies. And also the quality of growth matrices, they provide deep understanding of company benchmarks. So before setting up the goals on the growth and on the dynamics of the business, it's really reasonable and smart to build some of those matrices looking around your company, across your industry, across some industries where you also may have your counterparts in the business. You may have your suppliers, you may have your clients in different industries, and you will get additional insights, deeper insights in your benchmarks over the overall value chain, starting with the supplier, going to the production, your closest nearby competitors, and then moving forward to the distribution and to the clients. And you will see who are the best guys in all this value chain in terms of the value creation, who are the worst. And you will make your decision about your benchmarks, which particular types of your counterparts and which particular types of growth you really want to follow.